Welcome everybody to this video. We're going to kick off a very important topic within fixed income, namely repurchase agreements. This video is going to cover the basics, and we're going to have a subsequent one as well on the applications, the uses, as well as the risks associated with repurchase agreements. By the way, these things are typically referred to in the market as repo. That's short for repurchase, kind of short for repurchase. And this video is going to involve not just theory, but also some computations, and it's an important topic to master. Highly likely to be in some way tested in the exam. Okay, so what is a repurchase agreement? There are different ways to analyze it, but there is the economic sense of it, there is the legal structure of it. At the bottom of it, it's just a very specific way to arrange collateralized or secured loans. So it's a collateralized, that is secured, loan. That is at least its economic substance. So what the transaction is all about, economic substance. And you may have, if you studied some accounting or financial reporting, know about the concept of, have heard of the concept of substance over form, or economic substance over legal form. Because even though this is the substance, what the transaction is all about, its legal form is somewhat different and more complicated. Because the way this collateralized or secured lending is undertaken is it actually involves two very important steps, or distinct steps. First of all, it will involve, so this involves or involving first the sale of a security. So a financial instrument, a tradable financial instrument, typically it's going to be a bond. So I'm going to say e.g. bond, and it's this security that will actually act as the collateral for the loan, which the transaction is all about. But simultaneously with that sale, there is simultaneous. Right, just looking how you spell simultaneous. I think that's the way. You sign or enter a simultaneous agreement to do the second leg, or the second part of this transaction. The two are absolutely intertwined. You agree to buy the security, that same instrument, e.g. the bond. So that's a security here, and here the same security, or an equivalent one, so to speak, a similar one, is bought back, or indeed repurchased. So and this is where the name of the transaction kind of comes from, on a future date. So we agree to perform this repurchase on some future date for a pre-agreed price. And that price is known as the repurchase price. So essentially, first you sell a security. In these examples, we're typically going to use bonds. So you sell bonds or a bond, but you simultaneously agree to purchase it in the future back for a pre-agreed price. And in the interim period, you have the money from the sale, but you have to pay it back together with interest later on. So this is a way to effectively achieve secured or collateralized borrowing or lending. And this security will either be the same one as you sold over here, or similar. For example, an equally good corporate or government bond, often government bond with the same quality as the one that was previously sold. Okay, so let's now try to graphically represent this transaction. In this video, we're going to do quite a lot of drawing of the process, so to speak. So On the left-hand side, I'm going to draw somebody who we will be describing as the security seller. After all, this transaction involves the sale of a security, but they will, at the same time, be the borrower of cash. So this will be the cash borrower as well. It's the same person or the same institution. On the other side, I'm going to have the security buyer. That's the buyer, for example, of the bond. But they will also perform the function of being the cash lender. So the person on the left-hand side, or the counterparty on the left-hand side, performs the initial step, that is the sale of a security. Like we said, e.g. a bond. As an example, typically bonds, these will be bonds, but doesn't necessarily have to be a bond. It could be shares, it could be equity securities as well. Now, obviously, the buyer of that security pays cash. And let's say, e.g. 10 million for this, 10 million euros. This 10 million euros, this cash, this is going to be later on when we do computations inspired by examples and end of chapter questions in your curriculum. This will be referred to as the purchase price, seeing as this is the price for which the security buyer purchases the instrument. And as we said before, simultaneously to this, they agree that on a later date, typically this is specified up front, but sometimes it's kind of left open. Let's imagine this is, for example, 30 days later. Repos are short-term borrowing transactions, so 30 days is definitely quite short-term, although in reality it gets a lot shorter as well. So 30 days later, look, this 30 days later, that's going to be the so-called repo term. Well, the second leg of the transaction will take place. That's the buying back of the security by the original seller. So once again, that same person, the security seller, will now repurchase the bond. Bond is repurchased, obviously from that security buyer who is now selling it actually, and very critically, the amount that will have to be paid for the repurchase is pre-agreed. It's known as the repurchase price. Please take note of this term. It will appear quite often. You'll have to distinguish between the purchase price and the repurchase prices belonging to those different stages of the transaction, different legs of the transaction. So repurchase price, one that is actually pre-agreed up front, and that purchase price will be composed of two elements. It will be, first of all, the 10 million, the original 10 million, so that was the original purchase price, but we will add to it a component of interest, okay? And that interest will be computed at what's known as the repo rate. And this interest is known up front. It's agreed up front. So the two sides, when they enter this transaction, they know how the interest will be computed. So it's a function of the repo rate, the interest rate, coupled with the duration or the term of the repo, the space of time between, the interval of time between the initial leg and the second leg. So look, at the bottom of this is the fact that the security seller actually gets cash which they can use for a certain number of days, this 10 million, but then later they have to pay it back. So you pay back the same, original 10 million plus interest for the amount of time that you were using somebody else's money, somebody was funding you, and the transfer of the security, the transfer of this bond, is really done so as to keep the buyer feeling safe. They are the lender of cash, and they want to feel safe about recovering their money. And because they actually hold the bond for those 30 days of however long the repo goes on for and lasts, they will not sell you the bond. They will not give you the bond back over here unless they receive adequate money back together with interest. If not, they'll just keep the bond, making this transaction very well collateralized or secured. Okay, now one thing you may have to do is actually compute the repurchase price. There are examples of this in your curriculum, and I could turn this into a sort of proper ABC style question, but I'm not necessarily going to do it now. Let's just hypothesize. Let's just do a quick off the back of my head example. Let's say that this is, for example, 4%. You'll always be given this on a per annum basis, so on a per year basis. So how would you go about computing the repurchase price using this repo rate and the repo term and the original purchase price? Well, we know that the repurchase price is going to be composed of the original 10 million euros, so the original purchase price, and interest computed on that amount for the 30 days at 4% per annum. So, sorry, that shouldn't be a plus. This should be a multiplication sign. I'm going to have 1 plus the interest rate, the repo rate, 0.04, expressed in decimal form, and what your curriculum authors assume in all the examples is the convention of the convention or the assumption that a full year has 360 days. So you're going to divide this by essentially by 360 and multiplying by the 30 days in the repo, or the way they put it is just take the full percent or whatever interest rate you've got given in the question and multiply by 30 over 360, the relevant number of days, because it was the repo term was 30 days here. That's why we have 30 here, and we assume that the full year comprises 360 days. Well, let's see what that's going to give on the calculator. I'm going to take care of what's in the fraction first. Remember, my calculator is kind of preset to have the algebraic operating system, AOS, so I can just do this sequence of operations that are in the brackets. 1 plus 0.04 divided by 360 but multiplied by 30. What's that going to equal? You can see it equals 1.00333, and now it's a question of simply multiplying by 10 million to see what we get. Okay, it seems that the repurchase price should be, after 30 days, 10 million 33,333.33 euros. Probably too much detail here, but you can see how it's a linear function of time given a certain repo rate and the original purchase price. Okay, that's one computation you may be required to do. There are plenty others that we'll discuss in just a moment. Please, for now, just note that the repo, I mean, this doesn't come from the curriculum, it's my sort of own interpretation of this. The repo is essentially a collateralized loan. So a loan that's granted by the security buyer to the security seller. That's the direction in which the cash is going. But it is, for safety purposes, for legal reasons, it's kind of disguised, it's covered up as a sale followed by a subsequent repurchase. Okay. So a little bit more of the sort of general theoretical knowledge about these things that you have to possess. Most repos, the vast majority of them, are going to be very short-term transactions. So this is the space of time between one leg and the second leg. So they are going to be very, not just short-term, but very short-term. In fact, the most popular one that you're going to encounter is something called an overnight transaction, an overnight repo. So that's borrowing until the next day. And they can, they go from overnight, the most common one, to obviously also more than one day. In the case of those repos which span over more than one day, we call them term repos. Don't confuse with the repo term, which is just the length of time. A term repo is a transaction with a lifespan of more than 1 day. Okay, what is more? The collateral, the securities being used are typically very high quality liquid securities. So most repos not only are very short term, but also involve very, once again, high quality securities that are passed over to the other side and later repurchased. Obviously, these are used as collateral on these transactions. So they're going to be very liquid and also involving very low credit risk or default risk. So effectively, things like sovereign bonds or bonds issued by very reputable corporate issuers. Okay. Now, another thing is that the collateral itself may be either a specific security, so basically a specific bond, like the 5-year bond issued by the German government paying a 2.6% coupon, kind of with a specific identification number, or a group of securities, so a kind of portfolio of securities, for example, government bonds with similar characteristics, with maturities of 5 to 6 years, and then we call such a loosely defined group of securities, we call it a general collateral, and the repo is therefore going to be general collateral repo. And the rate at which such repos are done will be known as the general collateral repo rate. So this is a bit like saying, yeah, let's arrange a loan, a collateralized loan, and as the collateral, we're going to use a basket of securities, nothing very specific, but those coming from maybe a specific government with a specific range of maturities, but you can pretty much throw anything in there into that basket, into that portfolio, as long as it meets the pre-agreed criteria concerning quality. Okay, so this is some very sort of introductory knowledge on what repos are. Let us now think about a problem that may happen in between that first leg of the transaction and the second one. Well, bonds can change their valuation, or securities provided as collateral may indeed fluctuate in value over that period of time known as the repo term. So how can you manage the risk of the collateral value, the value of the securities falling below the value of the loan? Okay, so due to what I said, the fact that collateral or securities may fluctuate, and they often do indeed fluctuate in value, there is that possibility of shortfall risk. And we're going to now talk about ways to potentially reduce shortfall risk. This is the risk that the value of the collateral supplied may actually fall below the value of the loan amount, which is not going to be good for the lender who wants to feel secure about, having adequate protection, adequate collateral in case the counterparty is unable or unwilling to repay their loan. So what can we do? Well, we can obviously do something very obvious. Okay, so these are ways. Let's just highlight this. We can use very high quality securities, such securities or those securities which generally do not fluctuate in value too much. Okay, well, that's a good idea. But there is one more which is going to be, or another idea which is going to be absolutely critical, and that is the use of something called initial margin. And here we're going to do a computation which you absolutely have to be aware of. Initial margin is calculated as the relationship between the security price and the purchase price. Right, okay, what's this? Well, we've seen the term purchase price over here. You saw that the purchase price is whatever the security buyer in the repo or the cash lender pays to the seller or cash borrower initially. So we've got at least the denominator of that fraction already defined. In a way, this is the loan amount, how much loan you are given, which you will later have to repay together with interest. The security price we haven't talked about, but this is basically the security market value, how much the bond, for example, is worth in the market. And what you typically want to see is that this initial margin should be above 100%, in the sense that this provides an element of over-collateralization. If it's more than 100%, it means the value of the market value of the collateral provided into the transaction, or indeed what is over here referred to as the security price. So the top of that fraction, the security price, the security market value, which basically means the market value of the collateral, should be higher than the purchase price, which is the amount of loan provided or amount of loan granted against or on the back of that collateral. If you keep that relationship as follows into that kind of inequality, you're going to have the lender being over-collateralized, which is a comfortable situation for them. So let's do a little bit of an example, a numerical one, so that you see how this may actually be, or how this concept may be examined in an exam context. So the example is going to be as follows. Imagine we've got a repo arranged with initial margin equaling 106%. And the security price, please get used to interpreting this correctly. The security price is the market value of the collateral which is going to be used in this transaction. Let's say it is 100, not just like before, 10 million. We had 10 million euros as an example that I used before, right? Now, if you provide collateral with a market value of 10 million, you will not necessarily receive a loan for the full amount. Nobody will typically give you such a loan on the back of this collateral. So what will happen is, right to the left-hand side, we've got the borrower of cash, who is also the security seller. On the left, we're going to have the lender, who is the security buyer. Obviously, lender of cash, borrower of cash. Later on, we'll also talk about this in the context of borrowing or lending securities. And we know the security. Imagine this could be a bond with a value, market value of, like we said, 10 million euros. That changes hands, goes that way. The question is, how much is the buyer going to pay you? What's going to be the purchase price? Well, if this was a normal sort of cash transaction, cash market transaction, where you are selling the security outright, sometimes you'll see sales being described as outright sales. An outright sale is just a market transaction which doesn't involve any subsequent commitment to purchase the thing back. So if you just sold the thing in the market, you would get the full, I guess, the full 10 million minus some transaction costs. But because this is part of what in essence is a borrowing transaction, a collateralized loan, you're not going to get the full value lent to you. We have to compute basically the purchase price from this formula for initial margin, which is it's the relationship between the security price and the purchase price. So initial margin, in this case being 106%, that's what we were told, this is what I created or invented, is the relationship between let's have a look again, the security price, so the true market value of the collateral, and purchase price. Security price and purchase price. Purchase price is the term we're looking for, this one. We know the security price because we know the market value of the collateral to be 10 million euros. Okay, so just a very, little transformation that we need to do here. It means that the purchase price is going to equal the 10 million effectively divided by 106%, or simply divided by 1.06. That should be a fairly easy computation to do on the Texas Instruments calculator. 10 million divided by 1.06, the same as 106%, gives us a price of 9,433,962.64, and that is how much you're going to receive over here, 9,433,962.64 euros. And at this point, it is absolutely critical that you appreciate that this will now form the basis for computing the subsequent repurchase price. So on a later date, like 30 days later or 5 days later or the next day, in the case of an overnight transaction, that security or a similar one will be repurchased by the borrower of the cash, or the original security seller, and the amount they'll have to pay over here, this repurchase price, will not be the full market value of the bond, which is what you'd have to pay if you did this in an outright cash transaction, cash market transaction, which wouldn't be part of anything more sophisticated. Here it is part of something more sophisticated. It's the second leg of a two-legged deal. So the repurchase price is absolutely rooted in this 9,433,962.64, which we received when the securities was first sold or purchased by the lender, to which we will have to add some interest And this interest is going to be a function of the repo rate, which was pre-agreed between the two sides, the repo term, meaning how later is this happening, but the interest is always calculated based on the purchase price, on the amount of money that you initially received and you kept it, or you had access to it for a certain amount of days or weeks. So it's based on the purchase price, but also the repo term, and also, of course, the pre-agreed repo rate. Okay, hopefully that's clear enough. I just want you to appreciate that there is another way to look at this, which you may also be examined on. That difference between the purchase price and the security value, the security price, may also be expressed in terms of something known as a haircut. Okay, now a haircut, which is genuinely the term we use in finance, it's the difference between the security price, so that's going to be its market value, the purchase price, which is the lower amount, divided by the security price. Okay, so using the same data as we had above, a security with a price of 10 million in the market, so that was the market value, and a purchase price of 9,433,962.64, okay, we would have 10 million, the full market value, minus that smaller amount, 9,433,962.64, divided by the original 10 million, or the full 10 million. And let's see what this would actually give us. I've got the, as you can see on my calculator, I've got the purchase price already, because I don't want to type it out kind of again. Oh, I can see that I just mistakenly omitted a number here. It's actually 962.264, so I just incorrectly took this from my calculator screen display. Okay, it's a very small change, so I probably didn't have to bother, but I've got the number. I just need to stick a minus here in front of it, add 10 million, see what the difference is. Okay, it's this much, and divide by 10 million. And it will provide me with a haircut computation that is 5.66% thereabouts. But if I take the full number, it's 5.66037774. This is expressed as percent. Now, these are very much linked. That is the haircut and the initial margin, but they represent two different ways of looking at the same kind of thing. And I want you to appreciate where that difference comes from. So, on the one hand, you've got the security price, which is the sort of market value of the collateral that was supplied into the transaction. And then, simultaneously, but lower, you have the purchase price, the amount that you receive as the borrower of cash when you sell that security under a repo. Okay, what does initial margin tell us? In our case, the purchase price is this lower 9,433,962, and the reason why I'm trying to be as detailed as possible here with this so as to get as close a number as we can. Sorry. If you multiply the purchase price times the initial margin, which in this case was 106%. So effectively, if you take, let me type this in again, 9,433,962.264. If I multiply that by 1.06, I'll get a very nice 10 million, which I know to be the actual true market value of the security being supplied into the repo. The haircut kind of works the other way. If you take that 10 million and you deduct the haircut, so you kind of shave 5.66% from 10 million, what are you going to be left with? Well, let's have a look. 1 minus 0.0566. So this is me expressing the haircut in decimal format. 03774. I hope to God I got this right. Which means if you deduct the haircut from sort of 100% of the market value, you're going to be only left with 94 point something percent. And if we multiply that by 10 million, yeah, of course, we kind of get this purchase price, 9,433,962.26. Okay, I'm missing a little number, but you know, it doesn't really matter. Even though your book doesn't say this, I think it's useful to kind of be comfortable with transitions between the two. So a shortcut that I sometimes use, if I need to, or if I were taking the exam, I would need to use perhaps this shortcut. But you know, it's good to at least appreciate that you can do this. Is to say that the haircut, and let me stress, this is not in your book, so it's not something that's required. It can be computed as 1 divided by the initial margin minus 1. But you'll have to invert the sign, so you'll have to stick a minus in front here. Let's check if this works using the data that we had over here. In our case, the initial margin was 106%, wasn't it, somewhere here? Yeah, initial margin 106%. So let's try to do this. I'm going to retain the minus, and I'm going to have 1 divided by 106%, so 1.06. And deduct the 1 and see what comes out. 1 divided by 1.06, let's press equals, deduct 1 and invert the sign, and you can see the haircut being 5.66037, etc., etc., 4%, which is exactly what we had before. So, you know, just be comfortable with these transitions if you want to potentially be able to quickly solve such questions without having, you know, too much to do too much thinking, so to speak, in the actual exam. Okay, let's do one more numerical question. Once again, I'm just going to provide you with some data, and you try to solve this independently on your own, and then you can freeze the video and then see what the official solution is. So the example is going to be as follows. I wrote some numbers out. Let's have a security which will be used as collateral, whose price in the market currently is not 10 million, let's make this 100 million. And by the way, in the exam, or in the curriculum, so also in the exam, you will probably be told that initially the price at which the security trades in the market, its true market value, is the same or is equal to its face value. So the security initially in the market is trading at what we call par, trading at par value, or for 100% of its face value. Just to make life easier for you, so 100 million is also equal to the face value of the security. In the case of a bond, it's going to be the amount which the issuer promises to pay you on the maturity date when it comes to the redemption of the debt. Okay, what else? We need an indication of the initial margin. So let's make this 103%. What else? The repo rate. What's the interest rate on the collateralized loan? Let's make this, or let's keep this at 4%, just like in the previous example. Obviously, I've reduced the initial margin because previously it was 106%. I've made it less severe. And let's also imagine a repo term. Previously we had, I think, 30 days. Let's now make this 15 days. A shorter one. Remember that the most common term is going to be something very short. That's overnight transactions. That is transactions that last until the next day. So just to illustrate things, or make sure we understand how this works sort of graphically, you're going to have the borrower on one side, the lender on the other, and obviously the borrower passes over the collateral. Here, that collateral is worth 100 million. That, let me emphasize again, is the security price, right? That's the security price. Because if they use these terms in the exam in line with how they use them in the curriculum, you have to understand what security price means. It's not the price you will receive, because the price you receive over here is the purchase price. And that's going to be lower because initial margin is over 100%. This security price is what you would receive if you sold the bond outright in the market, in the cash market, in an outright transaction, which a repo isn't. Okay. Let's compute this. Initial margin, remember, is the relationship between the full security price and purchase price. And the reason why it's going to be high is because the purchase price is going to be lower than the full true market value of the collateral. So, in order to compute the purchase price, we just need to work with the relevant fraction here. Say this is the security price, which in our case is, it's not 10 million. It should be the full 100 million over here, divided by the initial margin, which is 103% or 1.03. Let's see what that gives. 100 million divided by 1.03. This is not the same as deducting 3%, right? Dividing by 1.03, by the way. Just in case you're tempted, 97,087,378.64. Okay, so that's how much the seller will receive, or the borrower of the money will receive. You could obviously turn this into a haircut if you really, really wanted to. Now, what I want you to do is calculate the repurchase price. In the questions in the exam, you may need to calculate the purchase price, you may need to calculate the repurchase price, or actually calculate both, in the sense calculate the repurchase price, but in order to do that you'd need to have the purchase price calculated first, because the repurchase price is very much a function of the purchase price. Okay, try to do this, freeze the video, stop the video, try to do it independently. You've got the data, you've got the repo rate, you've got the number of days, see what you get, and then freeze the video or unpause the video and see what the official solution is. Okay, so the way I would approach this, or the way you should approach this, is to say the repurchase price is equal to the purchase price. So that 97,087,378.64, of course. So this plus the interest that will be computed. But the best way to compute the interest is simply to say, okay, take this, multiply it by 1. 1 means you've got the purchase price, plus the interest computed on this amount, and it gets calculated at 4% per annum per year. So 0.04, and now scale this down to the repo term, which was just 15 days. So times 15 over an assumed 360 days. They should tell you, ideally, how many days to assume in the year. But if they don't, please be aware that of the fact that all the examples in the book are based, at least in this chapter, are based on this 360-day assumption. So let's see what this gives. I've got the right number on my calculator to start with, so that 97 million, let's multiply this by, I'm opening a bracket, and I'm doing 1 plus 0.04 multiplied by 15 over 360, close the bracket. Let's see what that gives. 97,249, 190.94. Okay, brilliant. Euros. That's going to be my my repurchase price. And obviously, in the exam, you may need to perform the same thing. It's just going to come with ABC answer possibilities or alternatives. Right. There is one more topic that I want to, one more idea that I want to discuss when it comes to repos. But let me just scroll back to that very beginning of this session, of this video, when we discussed the general framework for the repo. And so I want to just add, I guess, one more point here at the very start. What's very important to appreciate is that even though the security seller sells the bond, sells the security to the other side, they do not lose the connection to it. So this person, whoever they are, they retain, let me make my screen a little bit bigger, they retain, or the seller retains, the benefits, the economic benefits, or the risks, conversely, associated with ownership. They may not be the owner, although whether you are legally the owner or not depends on whether where you are. For example, in America, it's kind of more discussable whether who is the owner during that period, whether legal ownership is transferred, and under, as far as I remember, New York law, it isn't. But where I come from in Europe, when you sell a security under repo, you legally transfer title or legal title to the other side. So don't worry about this. It's more of a legal thing. But the seller still retains the benefits and risks associated with ownership. Why? Because if the price of the collateral goes up quite significantly, they will absolutely get a benefit from it. Why? Because they've pre-agreed to repurchase that collateral for a fixed price. It's 10 million initial value plus some interest, but if during the repo term the bond appreciates in value quite heavily, they'll make a benefit, they'll make a profit from the transaction, because the amount for which they buy the thing back is not a reflection of its current value. On the other hand, if the price drops in the market, or the value of the thing drops in value, they will lose out, because they still have to perform the repurchase and pay that fixed 10 million plus interest, irrespective of how much the bond is actually worth in the market right here, right now, on that repurchase date. And if you are somebody who benefits from price or value appreciations and doesn't benefit or faces the risk of the prices dropping, even though you may not legally be the owner, you still behave and feel like the owner, or you are exposed to the benefits and risks that are classically associated with ownership. What is more, even if the security buyer temporarily holds the bond, and in Europe they would legally be the bond owner, and therefore receive any income on that bond, for example coupons, income on the bond has to be income on the security is going to be transferred to the security seller anyway. So this person over here will not only feel the benefits of price increases and have the risk of price drops, they will also receive any income that is temporarily received on the security, even though it's held by somebody else. And repo agreements have sometimes very or quite detailed rules about how that transfer of income is done. That's not a topic for the CFA Level 1 exam. Nevertheless, you should be aware of this. Okay, let me go back to a clean page, so to speak, because I want to talk about one more aspect, something called variation margin. Really important. Once again, something where you may need to show your ability, prove your ability to compute things. So, like we've said before, or based on the little example that we did before, the numerical one where I wanted you to do some independent computations as well, we computed a repurchase price, we had an initial purchase price, and we had collateral worth something. So let's make a drawing here. Let's do a drawing here. I've got the borrower of cash who's selling the security. We've got the lender of the cash, who's obviously buying the security. There is a transfer of collateral worth, it was 100 million euros. In return, cash is transferred this way, or the purchase price goes this way. And apologies for constantly repeating the same terms, but I think that kind of repetition is what will help you remember these things ultimately. So we've got a purchase price, 97,087,378.64. Let me write that down over here. 97,087,378.64 euro. Okay, and we know that later on there's going to have to be a repurchase for what is also a fixed price. Okay, now the question is, or the problem is, what if our collateral, the collateral that's been supplied to the other side, what if the collateral value drops whilst it is being held by the lender? Well, the lender will not be too happy about it, so here's a sad face, of the lender. And what they will do, this is absolutely ruled by the master agreement signed between the two sides, but they will typically have the right to request additional margin, requests additional margin. So what they do is they technically issue what's known as a margin call. It's the same thing as you would have with derivative transactions. In this case, it's a request for additional margin, or in fact, let me say this is a request for additional collateral. Although this additional collateral that's going to have to be supplied by the other side is known as variation margin. So saying additional margin is absolutely right, but the additional collateral requested is known as variation margin. Okay, and you need to be able to compute this. So let me write down the formula and then we'll see how it is applied. Variation margin, it's not as easy as you may think it is. This is equal to the initial margin that was written into the agreement, which dictated the difference between the security price and the purchase price, okay, times, and now watch out, I'm going to say the purchase price, but the purchase price at time t. It's not the purchase price from time 0. That was the initiation of the swap. Sorry, not the swap, the repo. And we deduct from this the security price at time t again. Sorry, I didn't want to do that. I wanted to highlight, but for some reason my computer refuses to highlight. Decided to, okay, now it wants to highlight. Now I now wanted to write. So the security price at time t. When I've got the recording software running, there are some lags, bottlenecks in my computer, I guess. Right, so we're going to use the same numbers as before, same example as before. And I've got the outline of that example over here. We already computed the purchase price. We know kind of what happened. But let me just remind you that the initial margin on this transaction was 103%. The repo rate was supposed to be 4. And let's now add the extra element. Let's imagine that we are 4 days into the transaction, 4 days after that initial repo trade inception, meaning t, or time, is going to have the value 4. So that's going to be what we referred to as t before. And let's additionally assume that the current security price, so that's security price at time t, is only, sorry, I wanted to write 98, I wrote 88, 90% of its face value. Face value in this transaction was 100 million, because I said before when I was introducing this example, let's assume that the thing trades for 100 million, that's its security price, and it's equal to face value, meaning that the bond, let's say, is trading at par or at face value. So face value, let's recall that this is, let's write down that this is indeed 100 million. And I want you now to try and calculate the variation margin. If you think this is easy, it's not as easy as it may look. So you may have a go, but if you don't really know or you don't have much of a clue how to do this, just watch me compute it. If you want to have a go, try to do it on your own. You'll have to account for the accrual of interest. That's the hint here. So this is going to equal, first of all, the let's open a bracket. The initial margin, well, that's easy enough. Initial margin is up here. It was 103%, so we take this 103%, and let's multiply this by the purchase price. Now, it has to be a purchase price expressed as at time t, which is 4 days after the initial repo inception. Now, originally, the purchase price was 97,087,378.64. So that's fine, but it's only a starting point. 97 million, I forgot the rest, 87,360 something, 378.64, okay, euros. But now we have to scale this up a little bit to account for the passage of time and the accrual of interest. This is basically the loan amount initially, but at time t, the loan amount has grown because of interest computations that kind of happen in the background, and interest grows at 4% per annum. So I'm going to multiply this by 1 plus 0.044% essentially, scaled for the 4 days that have elapsed, so times 4, but divided by 360. This is the sort of the very tricky element here to get this thing right. Close the bracket, and we still need to deduct the security price at time t. The security is trading at 90% of face value. Face value being, sorry, I wrote this down incorrectly. I omitted a set of 3 zeros because this was supposed to be 100 million, so it's only trading at 98 million. And if you feel lost at this stage, like what the heck is going on, why am I calculating this, don't worry, just compute it, and we'll try to make sense of it in just a moment. So let's take the calculator and try to do this again. Right, where do we start? I'm going to do 103%, so 1.03, multiply that by 97,087,378.64, multiply again. Okay, I've got 100 million. Well, that was that should have been expected, right? I didn't really need to do that, but it just shows you the relationship between the loan amount or the purchase price and initial margin, okay? And now let's multiply this by open bracket 1 plus 0.04 times 4 but divided by 360, close bracket. What does that give? Well, it gives 144,444.40. And if you still need to deduct the 98 million from over here, minus 98 million, it's going to give a result, equal to 2,044,444 44 or whatever, right? Okay. That's going to be the variation margin. In other words, the lender, seeing that the collateral has dropped, is going to ask the other side, the borrower, to provide additional collateral worth this much, or perhaps, although your book doesn't go into that, ask the borrower just to repay some of the loan. Now, let's appreciate the logic of this, the logic of what we've done. It's all about the relationship between the loan amount and initially the amount that was lent to us was 97,087,378.64. I got it from over here. I even wrote loan amount, where to support this loan we provided collateral that was worth 100 million. Of course, 100 million, as we just discovered, is quite naturally this number times 1.03 or 103% of the collateral value. So this is described as the purchase price. This was at time 0. This was described as the security price, at least at time 0 initially. But look, over time, this purchase price changes. And this is what we tried to express or capture over here. We took the original purchase price, or the original amount of loan, and we scaled it up, or we increased it due to the computation, or the so-called accrual of interest. At any given day following the inception of the swap, I keep saying swap, sorry, I mean repurchase agreement, this is going to become bigger and bigger. So at some point, 4 days later, we've got a purchase price at time t equal to 4. But on day 5, it's going to be even higher. Ultimately, this will go all the way up to the ultimate repurchase price, because the repurchase price follows computation, follows the same logic. We take the original purchase price and then we scale it upwards for interest, but over the full 15-day period, to give us the 97,249,190.94. So it goes all the way up to the repurchase price, which was 97,249,190, I think, 0.94. I may be mistaken. Okay, and this is what happens over the span of 15 days. However, what we have to monitor is the behavior of the collateral, because the loan amount or the purchase price is growing up to the repurchase price, but what's happening to the collateral? We want to have a situation where at any point in time, or we should maintain a situation where that relationship is still that relationship of 1 point times 1.03 to maintain the original initial margin level of 103% difference, right? So ideally, the collateral value should also be growing to provide the lender with the same level of safety, security, concerning the relationship between the growing loan amount with the interest and the collateral value, which should also be growing. However, collateral is in fact doing its own thing, right? Collateral, security prices, especially prices of bonds, may change to loads of different factors, including interest rate fluctuations, etc., political situation. So in our example, the case was that the collateral value on day 4 dropped to just 98. Sorry, that hardly looks like a 98 million. So it was definitely too low to satisfy the relationship. The variation margin that we were asked for over here is what the borrower needs to, the extra collateral that the borrower needs to supply to make up for the shortfall, to cover that shortfall. That's simply the logic of it. But even if collateral is steady, if it were steady at 100 million, keeping to 100% of face value or par value, it wouldn't be enough to support the relationship, because your loan is growing, your loan amount is growing, and if collateral is not growing at the same pace, then you'll have to supply variation margin, or you'll be asked for additional collateral or variation margin by the lender. However, there is one twist here, and if you look at the example that's given in the relevant section of the curriculum, you'll see that being explored. I'm not going to do that example. You can go and check it out on your own. It's the same computation, but if collateral value, instead of dropping, goes up quite a bit, so if there is the case that collateral value has gone up beyond what is required to maintain the initial margin relationship, this may result, obviously if the growth in collateral value is strong enough, in negative variation margin, as in deducting the current price of the collateral of the security is going to produce a negative result. And then that means collateral, is going to be returned to the borrower. The lender cannot keep collateral that is excessive in relation to the loan amount or the loan value or that current purchase price. All of this stuff, how the variation margin gets, how often we have these margin calls and variation margin settlement, the whole process of margining the repo, the collateral that's used, all the rules concerning the details of the transaction are typically going to be included in what's known as the master repurchase agreement, signed between the two parties to the trade, and that's going to contain all the details of how a specific repo will be dealt with.